Imagine for a moment that it is the autumn of 2008. The world wakes up one morning to discover that the global financial system, the invisible web that moves money from savers to borrowers, that funds homes and factories, that underwrites pensions and paychecks, has come within hours of total collapse. Lehman Brothers, a 158-year-old investment bank that had survived the Great Depression, has just filed for the largest bankruptcy in American history. Stock markets are in free fall. Credit markets have frozen solid. The most terrifying of all, people lining up at ATM machines are suddenly unsure whether their money will still be there tomorrow. This was not a natural disaster or a war. This was the great financial crisis of 2007 to 2009, the worst economic catastrophe since the Great Depression. To understand the crisis, we have to go back more than a decade earlier to the late 1990s and early 2000s, when the seeds were quietly planted. After the dot-com bust and the mild 2001 recession, the Federal Reserve slashed interest rates to historic lows, down to 1% by 2003, and promised to keep them there for an extended period. Cheap money flooded the system. At the same time, the U.S. government pushed a policy called the Ownership Society to encourage homeownership for more Americans. Laws were relaxed, down payment requirements were slashed, and lenders were practically begged to find ways to put people into houses. The stage was set. American families had always needed decent credit to get a mortgage, but around 2003 something new appeared, which was the subprime mortgage. These were loans made to borrowers with poor credit scores, little documentation of income or both. No job, no assets, and yet people were still approved. Teaser rate adjustable rate mortgages, or ARMs, let borrowers pay almost nothing for the first 2 or 3 years, then the payments would explode upward. And liar's loans let people state whatever income they wanted with no verification. But why would any rational lender do this? Because they didn't plan to keep the loans. They planned to sell them almost instantly. Here is where the magic trick of securitization comes in. A bank or mortgage company would bundle thousands of these mortgages, prime and subprime mixed together into a giant pool. They would then slice that pool into tranches, from super safe AAA-rated pieces at the top that would be paid first, to risky equity pieces at the bottom that would absorb losses first. The rating agencies, Moody's, S&P, Fitch, slapped AAA ratings on huge portions of these securities because their models said the housing market never crashed nationwide. Investors around the world, pension funds in Norway, banks in Germany, local governments in Australia, bought trillions of dollars of these mortgage-backed securities, or MBS, because they paid a little more interest than treasury bonds and were supposedly just as safe. But the machine didn't stop there. Wall Street created even more exotic instruments called collateralized debt obligations, or CDOs, which were essentially securitizations of securitizations. They took the riskier tranches of MBS that couldn't get AAA ratings, bundled them again, and through financial alchemy and payments to the rating agencies, they managed to turn much of that into new AAA paper too. Then came CDO squared, packages of risky CDO tranches turned into yet more AAA securities. And then the cherry on top were the synthetic CDOs, which weren't even backed by real mortgages but by credit default swaps betting on the failure of other CDOs. By 2006, the global market for these private label mortgage securities had ballooned to well over $2 trillion a year. Everyone was making money hand over fist. Mortgage brokers earned fat commissions the moment the loan closed. Banks earned fees originating and securitizing. Investment banks earned fees structuring CDOs. Rating agencies were paid by the very banks whose products they rated. Even homeowners felt rich as house prices soared. U.S. home prices rose 124% from 1997 to 2006, creating a $13 trillion wealth illusion. Home equity loans let people treat their houses like ATMs. The phrase "housing prices never go down" became gospel. Beneath the surface, leverage was exploding. Investment banks like Lehman Brothers and Bear Stearns were borrowing $30, $35, sometimes $40 for every dollar of their own capital. A 3% drop in asset values could wipe them out completely. Hedge funds were even more leveraged. The repo market, overnight loans backed by securities, had become a multi-trillion-dollar shadow banking system with almost no regulation. And ensuring it all were credit default swaps, or CDS, derivative contracts that worked like insurance on bonds. The notional value of the CDS market reached $62 trillion by 2007, more than the GDP of the entire planet, with virtually no collateral posted and no central clearing. The largest seller of CDS protection was AIG, the world's biggest insurance company, which collected premiums for years and set aside almost no reserves because regulators let their London subsidiary write unlimited swaps. The first cracks appeared in early 2007. Delinquencies on subprime mortgages started rising sharply as the teaser rates reset, and borrowers couldn't refinance because home prices had finally stopped climbing. In February 2007, HSBC announced massive losses on its U.S. subprime portfolio. By April, New Century Financial, one of the largest subprime lenders, went bankrupt. In June, two huge Bear Stearns hedge funds that were stuffed with subprime CDOs collapsed. The rating agencies finally began mass downgrades of mortgage-backed securities. Thousands of AAA ratings turned to junk overnight. Suddenly no one knew which securities were safe and which were toxic. The real panic began in the summer of 2007 when the asset-backed commercial paper market froze. Money market funds and corporations that relied on rolling over short-term debt backed by mortgage securities couldn't refinance. BNP Paribas, a large French banking company, suspended redemptions from 3 of its funds, citing an inability to value the assets. The word contagion entered every financial newscast. Central banks started pumping billions into the system, but it wasn't enough. 2008 was the year everything unraveled. In March, Bear Stearns, which was already leveraged 35-1, nearly collapsed over a single weekend when counterparties refused to roll over its repo loans. The Federal Reserve, in an unprecedented move, engineered a fire sale to J.P. Morgan Chase, and for the first time lent directly to an investment bank through the newly created Primary Dealer Credit Facility program. The market exhaled, thinking the worst was over. It wasn't. Throughout the spring and summer, Fannie Mae and Freddie Mac, the government-sponsored enterprises that owned or guaranteed half of America's $12 trillion mortgage market, teetered as losses mounted. IndyMac Bank failed in July. But the real earthquake came on Sunday, September 7, when the U.S. government placed Fannie and Freddie into conservatorship, effectively nationalizing $5.4 trillion in mortgage debt. Markets plunged. Then came the week that almost ended modern finance. On Monday, September 15, 2008, Lehman Brothers filed for bankruptcy after the government refused to rescue it and no private buyer emerged. At the same time, Merrill Lynch, facing the same fate, sold itself to Bank of America as a rescue deal. That same day, AIG was hours from collapse because it couldn't post collateral on its $440 billion CDS book as its credit rating was cut. The Reserve Primary Fund, a $62 billion money market fund heavy in Lehman debt, broke the buck, meaning its share price fell below $1, triggering a silent panic among institutional investors who yanked $300 billion out of money funds in days. The credit markets simply ceased to function. Banks wouldn't lend to each other even overnight. The TED spread, which measures the difference between interest rates of Treasury bills and the London Interbank Offered Rate or LIBOR, exploded from 50 basis points to over 450. Commercial paper markets shut down. Companies like GE couldn't roll over debt to meet payroll. The global financial system was having a heart attack. In the weeks that followed, the U.S. Congress passed the $700 billion TARP program after an initial rejection sent stocks down 9% in a single day. Central banks around the world slashed rates and injected trillions in liquidity. The FDIC temporarily guaranteed money market funds and bank debt. The Fed began direct lending to corporations through the Commercial Paper Funding Facility, started buying mortgage-backed securities outright, and eventually launched quantitative easing. In October, 9 of the largest U.S. banks were essentially forced to accept government capital injections to prevent stigma. The human cost was staggering. U.S. home prices fell 27% peak to trough, wiping out $7 trillion in household wealth. More than 8 million Americans lost their homes to foreclosure. Unemployment doubled to 10%. Retirement accounts were decimated. Globally, the International Monetary Fund, or IMF, estimated total losses at $4.1 trillion. Entire countries, Iceland, Ireland, Greece, were overwhelmed by banking systems that had grown many times their GDP. So why did all of this happen? At its core, the crisis was caused by a lethal cocktail of perverse incentives, misplaced faith in markets, and catastrophic regulatory failure. Lenders were rewarded for quantity, not quality of loans. Securitization broke the chain of responsibility. No one had skin in the game after the loan was sold. Rating agencies were conflicted. Regulators allowed massive leverage in the shadow banking system. Everyone pushed for homeownership at any cost. And perhaps most dangerously, everyone believed that housing prices could never fall nationwide, and that complex mathematical models could perfectly capture risk. Overconfidence met greed, and the result was near calamity. Yet from the ashes came profound change. The Dodd-Frank Act overhauled financial regulation. Stress tests and higher capital requirements made banks safer. The Volcker Rule limited proprietary trading. The Consumer Financial Protection Bureau was born. The G20 nations agreed to bring derivatives onto clearinghouses and exchanges. Living wills and orderly liquidation authority were created so no firm would again be too big to fail. And yet, more than 15 years later, we still debate whether the lessons have truly been learned. Leverage has crept back in some corners. Non-bank lending has exploded. Memories fade, but for those who lived through September 2008, the terror of watching the entire system teeter on the edge is seared into memory. It was the moment we discovered that modern finance, for all its sophistication, rests on something as fragile as confidence. When that confidence vanishes, even the mightiest institutions can fall in hours. So that was the global financial crisis of 2008. It wasn't exactly a storm, but a man-made catastrophe built layer by layer over many years. If you found this helpful, give this video a thumbs up and subscribe if you're new.